5-minute tax guides from your 5-minute tax guy. Short lessons to help you navigate the treacherous, hazardous, and totally unpredictable U.S. federal tax code. Itemized deductions. When completing a tax return, you need to decide if you're going to take the standard deduction or if you're going to itemize your deductions. For most taxpayers, the choice is clear, and even more so under the new Tax Cuts and Jobs Act, which became effective for the 2018 tax year. Most taxpayers will take the standard deduction, but if you're not one of those, then this video will cover itemized deductions so that you can get the biggest tax deduction that you are entitled to. Before we talk about any specific itemized deductions, let's take a look at a Schedule A, which is the form that the IRS uses to list itemized deductions. The Schedule A shown here is from the 2015 tax year, but the one for the current tax year looks almost identical with a few minor variations. Notice that the form is divided into sections, covering each category of deduction, including medical, taxes, interest, charitable, and other. This video will only cover deductions for interest. You can check out my other videos to get information on the other types of itemized deductions. The list of other videos in this series can be found in the description under this video. Interest is the amount or fee that you pay for the use of borrowed money. The following are types of interest you can deduct as itemized deductions on Schedule A. Home mortgage interest, including certain points, and investment interest. Home mortgage interest. Generally, home mortgage interest is any interest you pay on a loan secured by your home, your main home or your second home. The loan may be a mortgage to buy your home, a second mortgage, a line of credit or HELOC, or a home equity loan. This video will cover the changes made to mortgage interest under the new tax code, the Tax Cuts and Jobs Act, which becomes effective for the 2018 tax year and beyond. Changes made to mortgage interest under the TCJA. I will first list the changes made by the TCJA and then go over mortgage interest in general. There were two important changes in the legislation. Both changes are temporary in nature and are effective through the year 2025. The first change relates to the limitation on the amount of acquisition indebtedness that qualifies for the deductibility of interest. The limitation for married taxpayers is $750,000. This limitation applies for tax years beginning after December 31st, 2017, and is applicable to acquisition indebtedness incurred after December 14th, 2017. For acquisition indebtedness incurred before December 15th, 2017, the limitation continues to be $1 million. The second change relates to home equity indebtedness. For any interest on home equity indebtedness, no deduction is allowed for home equity interest debt for taxable years beginning in 2018. Yes, you heard correctly. You can no longer deduct interest on your home equity line of credit, commonly called a HELOC. Debt limit is now $750,000 for acquisition debt incurred after December 14th, 2017. Yes, this means that loans that were in place on or before this date have the old limit of $1 million. Second homes carry on as they were, and mortgage interest debt for second homes is piled onto the primary residence when applying the mortgage interest deduction limits. Home equity loans. Interest on home equity loans, other than those used to purchase, construct, or improve the home securing the loan, are no longer deductible. Huh? Let's say you have a home equity loan that is used to buy a car. The mortgage interest is not deductible. However, let's say you have a HELOC, fancy word for home equity line of credit, that is used to add a wing for your mother-in-law. Then this debt is being used to improve the property that is securing the loan. This interest is deductible with the limits applied above. The flowchart on the right, which can be found in IRS Publication 17, will help you determine If you borrow money to buy property you hold for investment, the interest you pay is investment interest. You can deduct investment interest subject to the limit discussed later. However, you can't deduct interest you incurred to produce tax-exempt income. Investment property. Property held for investment includes property that produces interest, dividends, annuities, or royalties not derived in the ordinary course of a trade or business. It also includes property that produces gain or loss from the sale or trade of property producing these types of income or held for investment. Generally, your deduction for investment interest expense is limited to the amount of your net investment income. You can carry over the amount of investment interest that you couldn't deduct because of this limit to the next tax year, and the interest carried over is treated as investment interest paid or accrued in that next tax year. One final note. As with all itemized deductions, you must file a Form 1040 to claim any itemized deductions, including interest expense. You cannot claim itemized deductions when filing a Form 1040A or 1040EZ. For more great 5-minute tax guides, check out the other videos in my 5-minute tax guide video series. See the list in the description below this video.